Should we be thinking about the relationship between slack in the labor market and inflation differently? Do we not have the right measures of slack? Is it the problems with understanding what the natural rate of unemployment is? Or is slack really not the key to understanding inflation in the first place? Ben, you want to take that one first?
As I was talking about before, I think that the pandemic, to some extent, scrambled the usual signals from the labor market. And the Federal Reserve over time has begun to put more weight on things like the vacancy to unemployment ratio, which seems to give a better signal in a period of change when the labor market matching process is in change than the unemployment rate. So there has been some scrambling of those signals. That being said, it's simply not true that, even in people who've understood since the 70s, that there's not a simple inverse relationship between inflation and unemployment. In particular, what can break that relationship is supply shocks. And so during the 70s, we didn't particularly have tight labor markets most of the time. We had high inflation, A, because we had oil price shocks, which the Fed did not respond to adequately, B, because inflation expectations were not well anchored, and there was a strong tendency for price increases to feed into wage increases, to feed into price increases. So because of the presence of supply shocks and inflation expectations dynamics, there's no reason why low unemployment and high inflation can't coexist. But the remedies might be, depending on the situation, might be somewhat different.
Jay, how are you thinking about that?
So I'm very much in agreement with that. It's certainly true that we had both before and after the pandemic unemployment very low, close to 3.5%, but that we only had high inflation after the pandemic. Does that mean that our understanding of the relationship between slack and inflation is badly wrong, or that it has changed fundamentally after the pandemic? And my answer would be tentatively no to both of those questions. I think what really is different this time was the series of unexpected and persistent supply shocks that featured in the inflation process. I don't think labor market slack was a particularly important feature of inflation when it first spiked in spring of 2021. By contrast, I do think that labor market slack is likely to be an increasingly important factor in inflation going forward. In particular, inflation in non-housing services is showing signs of real persistence. In this highly diverse sector, labor costs are a high proportion of total costs, and that sector happens to account for more than half of the core PCE index. But all of this, the point is, all of this can be explained, I think, using our standard framework for understanding labor market slack. You could say it this way, that the natural rate of employment probably rose sharply as the pandemic severely disrupted the labor market. And the implication of that would be that an unemployment rate of, say, 4% indicated a much tighter labor market in 2021 than it did in 2018. And as Ben mentioned, of course, after the pandemic, we began looking at much more closely at alternative measures, particularly vacancies, but also quits, which have been signaling even greater tightness than the unemployment rate alone might have thought to have been signaled. I mean, to put some numbers on it, at the end of 2018 and the end of 2021, we had 4% roughly unemployment in both cases. In 2018, the vacancies to unemployment ratio was 1-to-1, essentially. In 2021, it was 2-to-1. And that was a much better indicator, obviously, at that time of the simple standalone unemployment rate. Although, as I mentioned, you could also think of it as the natural rate being highly elevated. The other thing is, it may also be the case that the Phillips curve has steepened, meaning that inflation has returned, at least for now, to being more responsive to changes in the labor market slack. But the Phillips curve was once thought to be fairly steep after flattening. Relationships in the economy, like the Phillips curve, evolve over time. So I would not characterize that as a problem for our understanding of inflation.